Hello, everyone. How was your weekend? Good, restful. I noticed my graduate students were expressing that they were tired because a lot of them worked on Vita this weekend. Anybody work on Vita here? Yeah, here was a pretty busy time. So yeah. All right. Well, I guess Vita is over for another year. So got that. So tax is done. Now it's the world of audit. Is that way we're gonna do it? Okay. Well, I guess audit would be a lot less interesting if I said we had volunteer audit assistance weekends. Yeah, that probably would not be as good. So today we are going to start our business processes. So we're going to start with chapter 10, 11. Today and Wednesday will be pretty thorough. I'm going to actually have you all have to do some work on your own outside of class. I'll get to that when I get to that. Next week will be a little bit lighter, and then we'll pick up the pace again in the final week. But this is going to be these two next lectures, Monday and Wednesday, are going to set the tone for everything we're going to talk about with the business processes. And I kind of already talked about it. We already know all the details we know to test accounts. We've already learned all the concepts. Now we're going to be talking about actual application of this information and what the implications are. Just as a reminder, I do want to make sure that everybody has on the schedule. I did talk about this on Friday, but I want to make sure everybody is on board. A week from this coming Friday, your Excel assignments are due. Please do not forget those. Please do not wait until the last minute to do those. I know Brightspace will remind you 2 days ahead of time. If you're waiting 2 days ahead of time, that's still probably sufficient time to get it done, but I would encourage you to start working on it sooner rather than later, especially if you encounter issues. So please start thinking about that. And then your professional interactions are due the week after that. So you do have some upcoming assignments in the very near future that you should be aware of. So let's start out with revenue process. So how many of you all in this room feel like you've got a pretty good grasp on revenue process? That you understand what goes on in revenue process? I mean, I hope that a reasonable grasp. You all had AIS with me, so we talked about the revenue process in there. What are some of the essential elements? If I was talking about the transactions that you would encounter in a revenue process, what would be examples of those transactions? Sale transaction. So revenue is about generating sales. So we actually generate the sales transaction. Okay, so we need to be aware that sales transaction takes place and understand the nature of the sales transaction. Also, when we talk about sales transactions, we have something called sales discounts. Everybody talked about sales discounts before in last. So I think you learn the accounting treatment for that. So if like you go in and you buy something that's on sale at the store, then they actually have to incur a discount on that sale of the item. So the sales discount would actually be reduced from the revenue value of that particular item. So you record whatever the sales discount is associated with that. So hopefully you remember that. What else? Assuming that we're in a business-to-business model, which is kind of what we traditionally think about for transaction analysis, we're engaging in sales on credit. Okay, so if we engage in sales on credit, what do we have to do after that? Collect the cash? Yeah, collect the cash. Okay, so we're going to collect cash receipts. That's going to be another item. And then associated with that, something called cash discounts. So cash discounts are frequent. They're not very common in business to customer models, but very frequent in business to business models. That's that 110/N30. Remember those initials? So if I say 1/10 N/30 or 1/10 comma N/30, everybody knows what that means. We pay within 10 days, you get a 1% discount on the cash payment. If we pay within 30, it's net. Okay. Anything else that we need to consider as well? So we got the revenue transaction, we got the cash sheets transaction. That's pretty much it, right? That's all we actually talked about in AIS, literally. But intuitively speaking, could there be something else that would be included in the revenue process? Has anybody ever gotten something at Walmart and then you open it up and said, this is damaged? Okay, I don't want this. So you go back and you return it. Or better yet, you try to return something and they say that we can't take it back, that instead you're going to get a refund, but you get to keep whatever you order. That's actually pretty nice when you order a pizza from a restaurant and they say, all right, you ordered the pizza and you ordered a pepperoni pizza. Instead, you got ham and pineapple, which is just the worst feeling in the world right there. And I got ham and pineapple. Says, this is not the pizza I ordered. Said, okay, we'll come pick up the pizza from you. Do they do that, or they just say keep the pizza and you get a new pizza? Hopefully it's the latter, which kind of at the college level that you're just hoping, I hope they send me the wrong pizza. So it's a twofer right there. Yeah. Anyway, what do we call those? Sales returns and what else? Allowances, sales allowances. What's the difference between a return and allowance? This is right here. This is my duck. This is William. Say hi to William. Yeah, that was not very enthusiastic. William's feelings are hurt. That's okay, William. So, every good accounting instructor has to have a bird. Okay, that's a lesson I was taught. So this is my bird. All right. So where did William come from? So William's about 10 years old. I bought him for a game of Munchkin. Has anybody played that card game Munchkin? In the card game Munchkin, there's a bird called the Duck of Doom, and I thought I'd like a Duck of Doom, and I ordered this, and I got this. This is not the Duck of Doom. This is the Duck of Gloom, because the Duck of Doom is yellow. William is black. Okay. So I called and I said, I shouldn't say I called. I emailed the company I ordered from Amazon, and I said, I really would like to get the Duck of Doom instead of the Duck of Gloom. And so they said, well, it would cost us more for you to ship this back, so you can actually just keep the duck. And so I got a free Duck of Gloom. So that's the story. That's an allowance right there. That's an allowance. The difference between a return allowance, I did not have to return William. William is now mine forever, and it's an impressive story and within the context of the revenue process. All right, so sales returns, or sorry, sales, cash receipts, sales returns, allowances. Those are all things that we need to keep in mind. Okay. So as far as what we're going to be doing moving forward, we're going to be talking about the cycle that includes all these items here. We're going to be talking about revenue process. Then on Wednesday, we're going to be talking the purchasing process. Next week, we're going to get to inventory management and human resource. And then we're going to talk about the steps of the financing and investing processes. All of these kind of fold together into a full comprehensive analysis of a business process within an organization. I'm not going to say we're going to cover every possible aspect of auditing business processes, but it is pretty thorough. Okay. So it's important to know what process area are we talking about within some context. In another context, we're going to be talking about business process as a very general term, because it's going to involve multiple business processes. So when we get to inventory management, for example, we already know that inventory management overlaps in both purchasing and revenues. So we're going to be talking about elements of multiple processes simultaneously. All right. Revenue recognition. Everybody remember this from 302? Remember talk about 302 revenue recognition? So if I sat you down right now and say, let's take a test on revenue recognition, you can give me the 5 steps of revenue recognition process, right? Okay, I don't believe you. I don't believe you. All right. So revenue is defined as inflows or other enhancements of assets or entity in the settlements of its liabilities, or a combination of both, from delivering or purchasing goods, rendering services, or other activities that constitute entity's major essential operations. Now, back in 2014, the AICPA issued a standards update, accounting standards update. It actually was not enacted until like 2017, I believe. But it's topic 606, revenue from contacts with customers. Prior to this particular standard, revenue recognition was different from different business areas. So how Taco Bell recognized revenue transactions was different from how Boeing recognized transactions, was different from how Bear recognized transactions. And this particular standard basically said, we're going to have one recognition model that's going to be applicable to all scenarios. Now, there are different cases or different circumstances that are involved in these revenue recognition steps. But for the most part, it's a one recognition model. Companies should recognize the revenue as they fulfill their promises to provide goods or services to their customers. All right. So it's important to note that this is part of our revenue recognition criteria. And so we need to understand this point. Now, again, we're talking about financial accounting, and everybody's always going to be asking, is this on the exam, Dr. Barnes? I said, I don't know, but it's definitely important for you to understand these concepts, because keep in mind, as auditors, we're going to be responsible for auditing this information. So we need to know what the steps are. So revenue recognition, the principles are consistent across industries. There's a cohesive set of disclosure requirements. Variable consideration is included in the transaction price. So anything that's included as a part of the cost of providing the goods could also be included in the transaction price. Identification of distinct performance obligations and allocation of transaction price to performance obligations. So that's basically our 5 steps in revenue recognition. We're going to distinguish those a little bit more. So actually, I shouldn't say these are the 5 steps, but these are the 5 concepts. The 5 steps are kind of moving forward. And they do with this thing called a performance obligation. So does everybody remember performance obligation from 302? Remember that term? So performance obligation is basically the criteria that must be met in order for you to recognize revenue at a point in time. Now, for some situations, revenue recognition based on performance obligation is easy. Think about going to Taco Bell and ordering a Mexican pizza. When do they get to recognize the revenue? When they deliver the pizza to you, okay? They make the Mexican pizza, you pay for it, and they say, all right, revenue recognized. What about for Boeing recognizing revenue on a plane? Okay, something that might take them many periods to make, if not years to make. Is it the same performance obligation? They only get to recognize revenue when the plane is complete. There could be steps in that. We could actually say performance obligation may be met when the fuselage is built or when the engine is installed. Regardless, we have to define the performance obligation. So this is what the steps are going to tell us. First of all, identify the contract with the customer. You can't have revenue unless you have a contract. Now, obviously speaking, when we talk about a contract with the customer, some of these are implicit contracts. Do you have a contract when you go and buy something at Taco Bell? You're going to say no, but is there actually a contract? The answer is yes. There is a implicit contract because they are actually providing consideration for the goods and services that you're going to purchase from them. So are you providing consideration? They're going to provide goods and services. So there's a contract. The elements of the contract do exist there. You have to be able to identify what those are. Secondly, identify the performance obligations of the contract, whether that be one performance obligation or multiple performance obligations. All those need to be in place. Next, determine what the transaction price is. So we need to understand what is the underlying amount that's going to be related to this particular engagement, to this particular contract. Allocate the transaction price to the performance obligations of the contract. Again, for Taco Bell, this is easy. You buy your Mexican pizza for $5. Your performance obligation is $5. For something like a Boeing jetliner, you're going to say the Boeing jetliner is going to cost $100 million. What portion of performance obligation gets allocated to each step? When you build the fuselage, is that $10 million? Is that $20 million? Whatever it is, you define those as part of the performance obligations in the price. Then finally, recognize revenue when the entity satisfies a performance obligation. So as the steps take place, as you meet those particular performance obligation points, that's when you recognize revenue in the transactions. All right, so kind of nice quick review of everything you learned about revenue recognition from 302. So that should be somewhat familiar, right? That's the starting point, because we need to make sure that everybody actually remembers the things about revenue recognition from your previous classes before we move on. Now we're going to talk about the audit concerns, okay? Let's go ahead and get into the details about what is going to be relevant to auditors. So first thing and foremost, revenue is one of the paramount areas of risk for an organization, particularly as it relates to misreporting and fraud. Now, can you think of any companies off the top of your head that might have misrepresented their financial position in the past in a way that might be considered fraudulent? Anybody come up with a name of a company that might have done that? Big E, Enron might have done that. Okay. FTX might have done that as well. Some recent companies, let's say Wirecard, Wells Fargo. Yeah, whole bunch of frauds. I will say well over half the frauds, I'd probably say on the area of somebody like 75 to 80% of frauds that we're going to see within the context of auditing all relate to the concept of inappropriate revenue recognition. That's the word I'm looking for. Inappropriate revenue recognition. Which makes sense because revenue is a path to the bottom line of an income statement. If you overstate your sales revenue, then generally your income is going to be overstated as well. So this is something that companies have done quite frequently. We as auditors need to be alert and understand that this is one of our primary areas of focus for the audit to make sure that revenue is appropriately stated. All right. So auditors should be alert when for auditing activities that are fraud risks related to revenue recognition. So here's some important fraud risk things that we're going to consider about. These are some very important concepts to be noted. The definition of these, by the way, are on pages 337 and 338. You can actually read to exhibit 10-1 for this first one, side agreements, okay? So side agreement is basically defined as a transaction that an entity engages in that it would not have otherwise engaged in without some sort of ancillary benefit. So say, for example, you're on the street and you're passing a lemonade stand and say, would you like to buy some lemonade? It says, no, I'm not thirsty. It says, okay, well, I'll buy something from you if you buy some lemonade from me. It's like, oh, well, if that's the case, I've got a chance to sell my car for that. That's a silly example, I know. But the idea being is that you would not have bought that lemonade had you not been persuaded to do something else associated with that. In business disciplines, that's pretty heavily frowned on. That's considered to be a lack of reasonable consideration because you're not buying for the actual asset that you receive, you're buying for some other benefit. So that's a side agreement. Channel stuffing, one of my personal favorites. Channel stuffing is one of those things where an organization identifies that they are not going to meet their earnings goal at the end of a period. So instead, they send out a whole bunch of sales, like maybe a whole bunch of merchandise to customers that did not order it at the end of a period. So the period passes, they recognize those sales revenues. The customer's right back, says, hey, you sent us a whole bunch of stuff we didn't order, we're returning it. Says, oh, so sorry, we'll issue a sales discount, but the sales discount doesn't get issued until the following period, okay? Channel stuffing was a really, really nasty scheme that occurred a lot back in the 90s and early 2000s. Doesn't occur as frequently nowadays simply because the controls are so much stronger than they used to be, but it is still something that's prevalent in smaller organizations. Then we have related party transactions. With respect to revenue transactions, we're very concerned as auditors that people who have related parties to our client may get preferable terms with respect to revenue transactions. So revenue gets understated because people who are related parties actually buy at a discount, maybe a steep discount or something along those lines. Then finally, bill and hold sales. So bill and hold sales were pretty common back again the same time channel stuffing was really popular. Bill and hold sales basically say that we know that a contract with a customer exists. So say we have a contract with a customer that buys a certain same amount of merchandise every single month. And so I'm here at I'm at the end of December, and I'm really, really short on my sales goal, and I see that I've got a customer that's going to be buying something on January 10th. I said, I could forward, or I could move ahead that revenue recognition, and I could say, I'm going to recognize the revenue in December, even though the transaction itself doesn't take place until January. What's the harm in doing that? I mean, it's actually a transaction we know is going to take place, is 100% going to the 100% possibility going to happen. So what's the problem in moving that transaction ahead? Well, does anybody see a problem with that? Violates a few rules that we've talked about. First of all, it doesn't meet that performance obligation criteria that we just got done discussing a little bit earlier. Also, there's a rule about recognizing or accelerating the recognition of revenues in accounting. That's a big violation of that. What is that called? Something conservatism principle. You guys remember that about conservatism says that we should defer the recognition of revenue, accelerate the recognition of expenses. Yeah, this kind of goes the opposite of that. So certainly bill and hold sales would be problematic. So again, so when we have a contract with a customer and we accelerate recognition of the transactions on the contract at an appropriate date and time. So those are all kind of fraud risks that we're concerned about. All right, let's go ahead and get to the overview of a retailer process. Okay, so there's a couple of ways that we could think about transactions from a revenue perspective. First thing is going to be a cash sale. And a cash sale is very, very easy. There's really only one recognition point, okay? There's the sale, and then there's the cash receipt that occurs simultaneously. Most of our transactions will not fall into this because we're going to assume that we're a large organization and business-to-business model. It is possible that this takes place. The good news for the auditing for this is very, very easy. All right. Generally speaking, this is not an accrual-based transaction, so we don't really have to worry too much about improper revenue recognition if a cash sale takes place. In fact, I would love it if we could actually go back to all cash sales or all cash equivalent sales, because then we wouldn't have that extension of credit and that misstatement of revenue or misstatement of receivables to inflate cash or to inflate revenues, to misrepresent financial position of organization and have big frauds and so on and so forth. But nobody asked me if I really, really like accrual-based accounting. I still keep saying, no, I don't like accrual-based accounting because it leads to fraud, but you know, nobody here likes to hear me whine. So I won't whine anymore, at least not right now. Okay, so now we're gonna be on credit sales. Credit sales are what we already know. This is the accrual-based accounting we've talked about. We actually have inventory sales go on credit and a subsequent collection of cash receivable, which result in a cash collection, okay? So basically speaking, we have two items that we're very concerned about. We're concerned about the recognition of revenue, and we're concerned about the collection of cash subsequently. So that's going to be really important because we're going to talk about two possible criteria that we need to consider when we're talking about the revenue process, or two possible events that we need to consider. Now, we do have the concerns about the sales revenue, or sales returns and sales allowances. I will get into that, but that's actually not as important and prominent as you might think. So to start this, let's go ahead and talk about what we're going to be using as kind of a framework for the next few chapters. So in the next few chapters in the business process, particularly this chapter and chapter 11, I'm going to stick to this very closely. I'm going to deviate from it a little bit next week and probably a little bit in the week after. But for this next week, I'm going to follow this very closely. We're going to talk about the types of transactions and financial statement accounts affected. We're going to talk about the types of documents and records, most of which you should be familiar with already. We'll talk about major functions, and then we're going to talk about segregation of duties as applications of those major functions. Okay, so a lot of detail that comes in the next few slides that's really important. So this one should be pretty straightforward, though. Three types of transactions typically processed through the revenue process. We've talked about sales. Okay, sales are the rendering of goods or services or cash or credit. Okay, This one's our first important pinpoint transaction types that we need to know within the revenue process. This also includes those sales discounts that we talked about before. So if sales discount does exist, this is where it would get recorded right here. Then we have the collection of cash, the receipts of cash for customers and payments for goods or services. So that's our second of our pinpoint transactions, basically noting that when we generate a sale, that we're going to have a collection of cash at some point in the future, a receipt of cash, which presents its own different risks that we have to be very aware of. This also would include those cash discounts we talked about before, that 110 comma N30, 1/10 comma N/30. That would be an example of a cash discount that we would record for this particular step. And then the third one, sales returns. This would also include sales allowances, like good old William here. So remember, returns of goods or services, if we actually our customer returns goods or services, we're not going to collect that as a receivable at some point in the future. That's where we have to acknowledge the receivable is no longer collectible. So we have to write off that receivable as part of that sales return or allowance. All right, this one's pretty intuitive, pretty straightforward, but let's go ahead and talk about some things that a little bit more detailed, a little bit more relevant. So this should just seem fairly familiar to you right here about what the types of transactions are and the accounts that are affected in there. Now you'll notice it says trade accounts receivable. What is the difference between trade accounts receivable and accounts receivable? Answer is there is none, okay? There's a trick question all along, okay? So trade accounts receivable is its official name, but accounts receivable is kind of the vernacular we use to refer to it. Could there be a distinction? Could you say that there are different types of accounts receivable? In some businesses, yes, but for the most part, trade accounts receivable and accounts receivable are synonymous. So when we have a transaction that affects sales, generally speaking, in our scenarios that we're going to be talking about, we're going to be talking about a credit to sales and a debit to accounts receivable, because we're going to be due that receivable at some point in the future. Also, it's important to note that because we do exist in a accrual-based environment, that some of our accounts receivable will not be collected. Unfortunately, there's never been a business model that existed where every single accounts receivable got collected 100%. I wish there was. That would be the greatest business model ever. But because we operate on this credit system, we do have to have some sort of allowance to account for that particular chance that we won't collect those accounts. Usually speaking, that's going to be the allowance for doubtful accounts that we create, which is a contra asset, and that's offset by the bad debt expense. So we're going to create the bad debt expense to replenish that allowance for uncollectible accounts, and then it gets written off as accounts become uncollectible. But going on to the next step, the cash receipts transactions, that's where we get our cash. And when we get our cash, we eliminate those accounts receivable because they're no longer receivable. They're actually being collected. That's also where we record those cash discounts. And then sales returns allowances, we record sales returns, sales allowances. And when we have a return or allowance, remember, we don't collect the receivable, it gets written off as well. All right. Hopefully you remember the accounting treatment for all of these particular transactions. I'm not going to test you on the individual journal entries, but it's important to remember how the transactions work because that's going to be critical to understanding how they get audited. All right. With respect to documentation, documentation should look pretty straightforward. Some of these are very, very obvious. We have the customer sales form. The customer says, I'd like to order from you. Here's the items that I'd like to order. If that's the case, then basically we receive their sales form and we agree to that. We then issue a shipping document and ship the items out to the customer. Once we've shipped the items to the customer, we give them a sales invoice because they said they need to know how much they need to pay. Presumably, they're going to pay us back, so they're going to send us back the payment. That's usually going to include a remittance advice, which the remittance advice tells exactly how much they owe, and they're going to record that in the item and in the cash receipts journal to record the payment of those items. There's a whole bunch of other items that are associated with that are bigger items, reports that are associated with this. Keep in mind that any transactions that are on credit have to go through a credit approval process. This credit approval process is considered to be a control. Should be something we'll see when we get a little bit later into the revenue controls. There's also other documentation that actually flows through the process. The documentation is usually checking to make sure that we understand what stage of the revenue process we're in, and whether or not we have received that we ship the items, whether we receive the cash, whether it's anything outstanding that we need to be aware of. Okay, so now we're going to go to the major functions. Now I'm going to tell you how I'm going to approach these major functions. First of all, we're going to talk about these major functions at a basic level. Then I'm going to go through these again, and we're going to talk about these from a segregation of duties perspective. And I'll explain a little bit when we get to that point, okay? So order entry, basically customer sends us a sales order. We agree that we're going to actually take in the sales order. So we accept the goods cut from the customer and enter them into the system. Before we can actually process the order, though, there is a credit authorization step, because remember, we are on a credit granting basis. We want to make sure that if we grant credit to a customer, they pay us back. All right. And again, when I say we, I'm talking about the client's perspective, not the auditor's perspective. But the customer is going to ask for credit. The client makes a determination of whether they grant that. If it's granted, then we move on to the shipping of the goods that have been authorized for sale. Then there's going to be the billing. That's where we send the invoice out to your customer and say, here's what's owed. And the customer hopefully will make payment on that. When they make payment, it's going to be the cash receipts. And then all of these transactions subsequently get recorded in accounts receivable and general ledger. So the accounts receivable is generally going to be at the subsidiary level, what the individual entity is. So whoever the customer is. General ledger is going to be at an aggregate level. All right, so I said that we were going to talk about this from segregation of duties, and now I want to explain what I'm going to be doing, because I'm going to do this a lot for the next few weeks. Generally speaking, we're going to aggregate these functional areas into one of our three responsibility areas. This is not a clean depiction and not a clean separation. As we go through these, I'm going to say, this is one type of process, this is another type of process. This is for simplicity and understanding. In the real world, you may have some overlap, like you may say billing is going to be more than one functional area, and I will agree to that. But for our purposes in here to understand what the functional areas represent, we're just going to try to keep them down to one process area, okay? So when we talk about order entry, well, I'm gonna start and I'll do some that are a little bit more challenging, but I'll help you. You guys can help me out for the ones that are less challenging. So for order entry, I've got three possibilities. I've got custody of assets, authorization of transaction, or recording of transactions. For order entry, this is basically where we accept the customer goods and record them in the system. This is going to be a recording function, okay? A recording function. Does everybody see what I'm doing with that? All right, now you can help me out with the next one, okay? This one may be a challenge. Credit authorization. So approval of customer orders and custody creditworthiness. Is credit authorization a custody step, an authorization step, or a recording step? What do you guys think? Others that you guys stepped on that really, really quick. Good job. All right, right. I didn't have to prompt you at all. Really well done. Okay. All right. So shipping of goods have been authorized. The goods are in the warehouse. Goods are in the warehouse. Those goods represent assets that are owned by the entity. So would shipping be a custody of assets, authorization of transactions, or recording of transactions? Custody. Okay. Can we talk about shipping? Those are the people who have custody over the shipments that go to the customers. So shipping is a custody function. All right, billing. This is one that's a little bit more challenging, okay? It says issuance of sales invoices to customers for goods shipped or service provided, also processing billing adjustments for allowance, discounts, and returns, okay? By and large, I would classify this as a recording function. It's not clean. I will say that there's probably authorization steps that go into this process, but for the most part, we're going to consider this a recording function. Now, I would like you to make a note of this, all right? We're going to look at the mirror of this on Wednesday when we get to purchasing process. All right. We're going to be looking at steps that look almost identical to these, but they're flipped in the situation that we're the one purchasing rather than we're the one selling. In the revenue process, I'm going to classify this as a recording function. I'm going to classify it as something different when we get to the purchasing process. So please make a note of that. Cash receipts. Cash is an asset. So what are we going to talk about with respect to custody, authorization, recording? What is this one? Cash receipts. So custody of assets. So this is probably a custody function. Okay, cash is a custody function. Then accounts receivable and general ledger. This one's a little bit more challenging because these are actually journal entries into journals at the system level. I will say that these are both recording functions. That being said, they're fairly redundant recording functions. One's at the subsidiary level, one's at the general journal level. And you'll understand what I mean by why I say these are redundant functions. These are both recording. They don't represent segregation of duties. But it's important to have both of these steps in the process because we want to know what the activity is at the customer level, as well as what the activity looks like at the aggregate level. All right. Everybody feel pretty good about this? Does everybody have a fairly reasonable understanding? If that's the case, let's test your knowledge here, okay? So the credit function should be segregated from the billing function. And the reason why they say that is that if one individual has the ability to grant customer credit, or credit to a customer and also has ability responsibility of billing that customer, it's possible for sales to be made to customers who are not creditworthy. That's going to result in bad debt. Boy, that sure sounds like a risk. What are we segregating out in this particular one? This first one, credit separation, separating from billing function. So we said credit. What was the other word after credit? Authorization. Okay, credit authorization. So this is an authorization step. Separated out from which one we said billing was? We said billing was recording. We're separating out an authorization function from recording function. Why? Because if somebody has the ability to both bill the customer and authorize credit, they could actually have transactions that to customers who are never going to be repaid, which is why we separate out those responsibility areas. I want to skip number 2. I want to go to number 3, okay? The shipping function should be segregated from the billing function. So if somebody has responsible for shipping goods and billing, you can actually have unauthorized shipments, and for the usual billing procedures to be circumvented, could result in unrecorded sales transaction and theft of goods. All right, so shipping, what did we say that type of responsibility was? Custody, and then we said billing was recording, okay? Separating out billing from recording. If we fail to do so, they can make unrecorded sales transactions and steal goods from the organization. Let's go to the third one. Okay, so cash receipts should be segregated from accounts receivable. Cash receipts, we said, is what? Custody, and then accounts receivable is going to be recording. Okay, so custody and recording again. One individual has both access to cash receipts and accounts receivable records. They could cash could be diverted, and shortage of cash in the accounting records could be covered. So somebody who receives the cash could put the cash in their pocket and say, "I never received the cash. I'm responsible for recording. I never received it." Yeah. That could, or they could say it was uncollectible, something along those lines. So separation out of custody and recording. You notice I skipped number 2, and it says accounts receivable should be segregated from the general level ledger. And I want you to make a note of this because this one's always darked me off. This is not true segregation of duties. All right. The reason why is these are both recording steps. However, as I pointed out before, having the segregation in this responsibility is really important because it's a redundant recording step. What gets recorded at the aggregate level also gets recorded at the subsidiary level and vice versa. So this is not really segregation of duties, but it's something that we're going to acknowledge is actually good for the process to make sure that we record things correctly within the system. All right, everybody feel pretty good about that? Feel like if I gave you a question about segregation of duties on the exam, which I very definitely will do, that you feel like you could approach that? Okay, we're going to look at a lot of examples of this. This is not our first time to this. It's not going to be our last. Okay. All right. So inherent risk assessment. Examine the revenue process. Auditors should consider inherent risk factors that may affect both revenue and cash receipts transactions and the financial statement accounts affected by those transactions. There's 4 specific inherent risk factors that may affect the revenue process. All right. First one is pretty obvious. Industry-related factors. If you're operating in an industry that's very volatile and competitive, that's going to present a risk to the organization. Okay. Just ask the makers of BlackBerry. Okay. Makers of BlackBerry. Certainly, we had some problems with the industry-related factors there. It's not the last time I'll talk about BlackBerry either. Complexity and contentiousness of revenue recognition issues. If you've got contentious revenue recognition criteria, it can create some inherent risk in the organization, which is the auditor needs to be aware of, particularly if the revenue recognition process is really challenging. It requires specialization. It requires a lot more detail to understand about what's going on there. The auditor may want to make sure that they understand that there's a great increased amount of risk in that area. The difficulty of auditing transactions and account balances and revenue the revenue area. If it's very transparent, it's very easy to understand. If it's like a Taco Bell type environment, the revenue recognition is probably not all that hard. On the other hand, what if we recognize or try to audit revenue transactions in oil and gas? Has anybody ever seen transactions in oil and gas for audit? I have. I don't ever want to do it again. Okay. It is a bit of a challenge, a little bit of a chore to try to audit transactions or revenue transactions in oil and gas because they're extremely complex and non-intuitive. Then misstatements detection in prior audits. This is just a general statement. If we've had a client that has misstatements in prior years, we consider that to be an inherent risk moving forward because it's a possibility for misstatements could occur in the current period. All right, here we go. One of the favorite things to talk about is control risk assessment. For the revenue process, we are generally going to use a reliance strategy, particularly for publicly traded companies, because most revenue transactions are going to affect financial reporting. All right. By the way, you're going to hear me say this a lot. We're going to use a reliance strategy. I'm going to say it for 2 whole weeks before I finally move off of it. I apologize. I know everybody's really looking forward to the substantive strategy and we finally get to use that. I promise it's coming, but you're going to have to be patient. Okay. So we're going to use a reliance strategy now. We're going to probably use a reliance strategy. I shouldn't say probably. We're definitely using a reliance strategy on Wednesday and then next week as well. But we'll talk about why. Remember, reliance strategy is where we're relying on clients' internal controls. We have a lot of revenue transactions that occur in an organization, so we probably need to rely on their controls to some degree. So we need to actually document control risk and test controls. So what are the things that we're going to be concerned with? Remember, we've got our assertions related to transactions and events, which is basically all of our management assertions except for rights and obligations. We need to be responsible for understanding and testing those. So what are we going to look at? We're going to look at this thing right here. Remember this diagram? I've actually embedded it in the slides now. It's not just a separate image. I did that for you all, okay, because I care, all right? But I want you to have access to this control sequence diagram. This is going to be the foundation for how you're going to understand the controls testing process for these business processes. All right, so let's start talking about what it is that we're going to be doing. I'm going to give you 2 slides here in just a second that is just the tip of the iceberg. On these slides, I'm going to refer to tables in each of these chapters. There are 6 tables that you will need to be aware of. The first of these 2 tables will be in the revenue chapter. The next 2 tables will come from the purchasing chapter. There will be a table in the invoice processing chapter, and then a table, or sorry, in inventory management chapter, and there will be a table in human resource management. There will 100% be a question or a problem on the exam that's going to follow this pattern. And basically what the problem is going to say, here is the risk that we're facing. What is a concern that, or here, what is the assertion related to this risk? And you'll have to identify the control and the appropriate test controls associated with that. Do we have time to do every single possible combination of risks and assertions in this course? Well, let's see. It's 2:06 right now. I'm getting ready to go through 2 examples, okay? That'll probably take me about 4 or 5 minutes just for those 2 examples. So I'm going to say no. So when I give you the table number, it is your responsibility to review those tables outside on your own. If you do so, you should feel fairly comfortable about this process. If you do not do so, the exam is going to be a rough time for you, okay? But we'll get to that in a little bit more detail about what it is I'm looking for. So let's go ahead and look at an example here, all right? So this is the first one, is our first table. This is table 10-6 on page 351 in the textbook. This has to do test controls specifically related to revenue transactions. So what did I say was our primary management assertion we probably are concerned about here? I didn't actually tell you the assertion, but I said fictitious sales are certainly a problem. Didn't I say that was a risk that associated with many organizations? But I'm talking about fictitious sales. What is probably the assertion associated with that? That these fictitious sales don't actually exist. So it's existence, okay? So management assertion of existence occurrence, and of course, sales to fictitious customers, okay? I'm concerned that we may create fictitious customers to falsely inflate sales, or like that our client may do that, okay? I, as the auditor, am concerned about that. So I say, show me an example of control that you have in place to make sure that there's no way that customers can get created that are not real. So what would be a process for doing that? We'd have to understand the process for which customer creation is generated. So the customer would say, I'd like to order, all right? So there's a recording step, and then there's an authorization step that vets out to make sure that these customers are reliable, that are very creditworthy. What do we call that when there's a separation between recording and authorization? Segregation of duties, okay? So I could say, let me check the segregation of duties in the customer creation process. If there's a separate step between the customer order and the customer authorization, I'm pretty happy with that as an auditor, all right? So what are we going to do? What are we going to do? We're going to check and make sure segregation of duties is in place. And this is probably not the only place that we can have segregation of duties, but this is the obvious one. I don't want fictitious customers being created. So client says we have proper segregation of duties in place in this area. Now I have to test this as an auditor. What am I going to do as an auditor when I'm testing this? Am I going to say, send me all the documents that you've got everywhere? Is that a test of segregation of duties? No, it's not, okay? I tried to make you all fall for the trap and you didn't respond. Either you didn't know or you were just way too smart for me. I'm going to go with the latter, all right? So I want to see segregation of duties in place. I want to see the process, all right? So what I'm going to do, I'm going to go talk to somebody and say, explain to me this process that you do for approval of new customers, okay, to authorization of new customers. Then I'm going to watch somebody do this task, and I'm going to make sure that they're following the protocols that are supposed to be in place. So I talk to people, I watch them do stuff, observation and inquiry, okay? I'm going to observe and inquire, evaluate the observation of proper segregation of duties. Now, is there more to it than that? Probably so, but that's probably a good first test of control step. So what did I do here? I specified the assertion, I specified the risk. Once I've identified that, I understand what the control is that I want to actually the client put into place. And then I determined what is the best way for me as an auditor to test that control. Does everybody understand this step, the sequence that we just followed through? Feel like you could do this on your own? Let's do one more. What do you guys say? Let's do one more. So let's do over cash receipts transactions. Okay. This is table 10-7 on page 355 in the book. So if you were looking for some light reading for this evening, you've got 2 tables in your auditing textbook now that you can review. All right. So cash receipts. Cash receipts. Could we say that there's a risk of cash receipts getting stolen before being recorded? So yeah, somebody sends the cash receipts, like sends cash to the client, and whoever's responsible for reading the cash receipt says, you know what, I could use some extra cash, and puts it in their wallet. Is that a possibility? That's a risk. If the customer or the client, or if the client doesn't have good protocols in place to adjust that or address that, then it's a possibility. So I'm going to say the assertion of completeness, cash receipts stolen or lost before recording. So that's certainly a problem. That's certainly a problem that could exist. Okay. However, there could be a solution to that, right? What if we never put the money in the hands of the client? What if there's never somebody at the client who actually gets their hands on cash from the transactions? Have we looked at something like that before? Does everybody remember back in chapter 7 when we did the IFRS walkthrough and we tested the blank lockbox system? So that was good old, I think it's William was his name. I don't remember what his last name was. But we actually walked through the internal controls did the internal controls walkthrough. And we actually, so he tested the bank lockbox system, and there was a cash exceptions report that he had to test. What was the whole thing behind the bank lockbox? That was actually where clients send or customers of the client send their money so that that never goes to the client's hands directly. It goes just directly to the bank account. Is that a good way to control against somebody stealing money from you? Is that if they never goes in their hands in the first place? Yeah. All right. So use of a bank lockbox system. So if that's the case, how do I test this? The good news is we've already tested this before. We've already talked about how we test this. Very first step, I'm going to go talk to management and say, hey, tell me about this bank lockbox system you use. I'd like to learn a little bit more about it and understand how this actually prevents people from getting their hands on cash. So say, well, the customers send their money to the bank, and the bank makes deposits for us and then sends us a report of all the cash receipts that are received. Just as easy as that. Are we going to have to do additional tests as auditors? Yes. Okay. But this is a good first step, and it actually relates to the control that we're testing. All right. So hopefully you should feel a little bit more comfortable with this idea of the alignment between the risk, the management assertion, the control, and the test of controls. If you're still a little bit uncomfortable, the good news is we got a lot more ahead of us. Okay. Got a lot more ahead of us, so we'll look more back at those. That being said, let's talk about what it is that we're going to be talking about with your sales returns and allowances. Now, basically speaking, we talk about sales returns and allowances. This is a very minor area for the revenue process. Okay. Generally speaking, it's not material. If it is material, this is where we as auditors step in and say, this should not be a material area. There should not be this many returns. There should not be this many allowance transactions. Why is it in a material account? We would step in and say there's probably a likelihood of a misstatement, and we test it individually. For the most part, though, the only thing we're going to be concerned about is going to be the processing of credit memoranda. So we'll make sure that credit memoranda has an approval other than somebody who initiated it. So there's a separation between the recording function and authorization function. And the credit for return goods should be supported by a receiving document indicating the goods have been returned. So there's documentation supporting the credit memorandum. That's basically it. All right. Substantive analytical procedures and substantive tested details we need to wrap up in this discussion. So remember, this is where we actually move into our accounts related to account balances, assertions related to account balances. We can still look at assertions related to transactions and events, but this is where we're going to be testing the balances and the financial statements as well. With respect to analytical procedures, I'm going to tell you, generally speaking, substantive analytical procedures over the revenue process are usually not that effective. There are some spots that we can use modeling to be helpful. Like if we wanted to model the allowance for uncollectible accounts, that could be a possible area. That's an area we could do estimates. But trying to do an analytical model for revenues as a whole is generally not going to be very effective. We found that out back in chapter 5. We tried to do that and it didn't work out real well. Most of the time, auditors are going to be limited to very basic analytical procedures, like looking at trends over time or basic ratio analysis. However, if you're curious about this, you can look on table 10-9 on page 360 in the textbook. It does have a list of analytical procedures. That being said, I do not hold high stock in analytical procedures over the revenue process. There's so very few that actually are relevant and that matter that much. All right, here we go. Let's talk about substantive tested details. What are some areas that we're concerned about substantive tested details? Well, we're talking about substantive tested details. This is the point where we're talking about balances. As we're going to find out, much of our focus when we start talking about these income statement process areas are going to be on their associated balance sheet accounts. So if I have a sales transaction, what does that usually mean for the balance sheet? What is that sales transaction going to be recorded to on the balance sheet? So credit sales, debit. Nothing, just credit sales. Yeah. It'd be a wonderful world. You just go back to single entry bookkeeping. So we have a sales transaction. We debit credit sales. We're going to debit accounts receivable. Yes, you can say it proud, say it loud. You spent 4 years in college. You should know this by now. Yes. Okay. Accounts receivable. Okay. So we're going to make sure that we test our accounts receivable. Completeness. All accounts receivable transactions have been properly recorded. Remember, completeness is a recording assertion. So we make sure that it's been recorded within the financial statements or recorded in the system. Existence occurrence. This is very important. This is the most important assertion related to revenue transactions. What do we want to make sure when we talk about existence occurrence? We want to make sure the account balance is not overstated through the inclusion of fictitious customer accounts and amounts. This is usually where the most common manipulation of revenue takes place. People create fictitious accounts receivable, whether that be with existing customers or customers who do not exist. Whatever it is, the balances are actually recorded too high. Okay, so they inflate their revenues. VAA, what's important with respect to VAA? Make sure that all accounts receivable are recorded their net realizable value and the allowance for uncollectible accounts is adequate. We could talk about the concept of factoring receivables. Factoring receivables is something that occurs quite frequently with respect to revenues, with receivables, where they sell receivables to an external party. That external party then collects the revenues. The idea being is that they want to collect their receivables earlier, get their cash ahead of time, usually at a discount. If a a client of ours sells their accounts receivable, factors those accounts receivable, they can no longer recognize those as accounts receivable on the financial statements. Okay, that actually relates to rights and obligations too. The accounts receivable are owned by the entity. Presentation. Want to make sure all necessary disclosures related to revenue transactions and accounts balances have been made. Classification. We got a lot to go on with classification. First of all, identify and reclassify any material debits contained in accounts receivable. The reason we say if it's a material debit, if it's something that we consider to be a material amount in accounts receivable, it probably would be better served to be considered to be much larger than accounts receivable, maybe something like a note, because accounts receivable individually are not considered to be material. At least they should not be with our organization. On those same lines, we want to separate out short-term and long-term receivables. Misstatement of or misclassification of receivables could be one way that organizations are trying to manipulate financial ratios. I know financial ratios don't seem like that much, but a lot of organizations may have debt covenants where they're required to hold a certain amount of liquidity. And if they're not able to meet those ratios, then they might try to misstate those to meet them. Along the same lines, I want to make sure that different types of receivables are properly classified. This has to do both with short-term and long-term, as well as notes versus accounts receivable based on size. Okay, we just want to make sure that they're properly classified based on the nature of the receivables. Then cutoff. All revenue transactions related to accounts receivable are recorded in the proper period. Okay, so we want to make sure that when a transaction takes place, that it's recorded in the correct period. That's the nature of cutoff, making sure that transactions are recorded in the correct time. All right, we have got a little bit less than 2 minutes and I've got multiple slides. I think what I'm going to do is I'm going to call it here. We are going to start off on Wednesday. We're going to finish up with confirmation procedures in chapter 10, and then we'll try to finish up chapter 11 from there. Anyway, have a good day. I will see you all on Wednesday.